An overview of markets. Fungibility. Fungibility is the interchangeability of financial assets on identical terms. Often a stock, future, or option will be traded on more than one exchange. It is especially important that financial asset being purchased on one exchange and sold on another is fungible. In other words, if a trader buys an S&P contract on the Singapore exchange and sells the same contract as defined by asset, amount, currency, and expiration on the Chicago Mercantile Exchange, he or she must be sure that the contracts are fungible. In what types of markets can technical analysis be used? Markets are simply meeting places of buyers and sellers. Market can be categorized in many ways. They can be categorized by assets being traded, the manner in which borrowers and lenders meet, or by type of contract that is executed. Types of contracts. Now let us look at categorizing markets by the type of contract that is executed. Two broad contracts categories are the cash markets and derivative market. The future market and option market are subcategories of derivative market. Cash market. The cash or spot market is the oldest type of market. In the cash market, a contract is entered into that will result in immediate exchange of agreed upon items. Different rules and conventions regarding the meaning of immediate apply depending upon types of asset being traded. Exchange Traded Fund ETF. In the past 20 years, a security called an exchange traded fund that replicates an index fund or a basket of assets has become extremely popular as a trading and hedging vehicle. Derivative markets. The term derivative describes a financial contract that derives its value from some other investment vehicle, often called underlying. The primary use for derivatives is to hedge against risk of loss in underlying or to speculate with high leverage. Futures markets. Futures contracts are traded in the future markets are contracts in which buyer and seller agree to trade at specific terms at specific future date. Future markets are often incorrectly called commodity markets more from historical usage than as a realistic description. Option markets. An option contract gives the holder the right but not the obligation to complete the transaction stated in the contract before the expiration date of the contract. There are two basic types of options, call and put. The call option gives the owner the option to buy as a set at particular price known as strike price before an expiration date, and put option is used for selling. Swaps and forward. Swaps and forwards are traded over the counter, not on exchanges where prices are continuous and visible. Often these contracts are specific to the parties only, not transferable, not freely traded, and do not have continuous prices. For these reasons, technical analysis is impossible. Swaps are contracts between parties agreeing to swap certain investment vehicles, one interest rate vehicle for another. Price weighted average. The Dow Jones averages are price weighted averages. This means that the prices for each of the component stocks are added together and the sum is divided by a divisor that has changed over the years to account for spills and stock dividends in each of the component stocks.